Hi everyone, welcome to today's AMA. My name is Moonshine and I'll be the host of today's AMA with LynxCap. And LynxCap is typically the future of real world assets investing and a next generation DeFi platform trying to combine blockchain technology with real world investment strategies to deliver secure, transparent, and sustainable on chain yield generation. So we have Felipe here with us. So Felipe, would you mind introducing yourself and the team behind your project?
Yeah, of course. Hi, everyone, and thanks for tuning in. Well, I myself, I'm Felipe, and I'm originally from Spain. I been working in the distressed investment sector for almost 15 years. I first studied economics and quantitative finance, and then joined the Swiss fund that basically specialized in these types of investments. Later on, in about 2019, so 7 years ago, part of the team from that company, we moved into another company, which is LynxCap, established basically the company LynxCap. And since then, we've been also very much doing the same, which is we analyze and underwrite and acquire distressed asset portfolios, which are mostly secured by real estate assets in several European jurisdictions, being Spain currently the most important market. Yeah, so that's why I'm happy to go into more detail later on, if you will.
Yeah, sure. I really appreciate that, overview about the background of the team and how you guys started the project. So, my first question is actually how the project positions itself as a solution to unsustainable yield problem in DeFi, which is real. So, but now, if these debt portfolios recoveries underperform rather than what you guys expect, are there any mechanisms put in place to fix the APY as promised to ensure the system is sustainable?
Yeah, sure. So maybe a bit of background before. I mean, we are a TradFi company. We've been buying and managing portfolios for about 15 years as a team. These investments, just for the audience kind of to understand a bit, it's portfolios of hundreds or of thousands of different loans that are backed by real estate assets, and they are bought at a discount from Spanish or European commercial banks, because these cases are not performing according to the loan schedule. The bank have to kind of provision them and downgrade them internally, and then they are forced by the European Central Bank to sell these periodically. So there are certain investors like us, and it's a bit a niche industry, but investors like us, we acquire and manage these portfolios, and because they are bought at a massive discount towards face value, there is a big margin that can be made. So we offer, and maybe a bit of personal background as well, because me as on private level, I've been in the crypto space for like, I guess 6-7 years, and I kind of started early into going a bit degen, let's say, and trying to invest into these protocols that promise you hundreds of percentage yields and so on. And then, of course, I got quite burned left and right. And the LynxCap DeFi platform, the LynxCap.io, is part of an answer to all of the scams and all of the projects that you find in the DeFi space that are really not exactly where investors should put their money. And basically what we're trying to achieve here is tell our investors, we can give you this. It's a 10% yield. It's not 100. It's not a 20. It's a 10. There is a lockup period for 2 years. We have to lock the funds up because we will take them and invest them into real assets that have a lifetime of 2-3 years. So this is why we can't have this liquidly available to everyone. We go off-ramp this money, invest it into NPL portfolios, then collect the money, then bring it back. So that takes some time, which is why we need to offer you a lockup. And this is what we can offer in a transparent way, because our investments, they have the same timeline and they have significantly higher yield than 10%. Our target returns are in the high teens or in the 20s, which means we can easily afford to pay our funders a 10% yield. So this is a bit why this is sustainable. When we say 10%, we say basically we commit to this number. It will never change for the entire lockup period. So any person who deposits money, USDC, into our platform, he can be sure that, you know, next day and next week and next month, the yield will still be 10%. And the yield is claimable, of course, any time. It's only the principal that is locked up. So yeah, this is a bit how we address the sustainability. I mean, there's no really sustainability being jeopardized, because we've been doing these investments for, as I said, more than a decade, and systematically achieve these returns.
Wow, it's actually very impressive to see that, or to hear from you that, you know, if one deposits, the 10% still remains valid even after coming back to it after a few months. So it's quite impressive to see how you guys have structured that system to remain, you know, very stable. So the next question I wanted to ask is, you know, I see that the treasury equity grows while this yield are paid out. So how exactly is this treasury growth allocated? And at what point does this treasury capital become large enough to materially absorb investment losses or economic downturns?
Well, I mean, we maybe one step back. So we, as mentioned, at LynxCap, we are a TradFi company. We have now over, I think it's around 31 million in outstanding debt. Our main funding instrument is bonds, like classic bonds that are issued on the Luxembourgish stock exchange. We are a regulated company. We are audited by Deloitte. Reports are available on our website. It's all very transparent. And LynxCap IO is like a new funding instrument, which would be backed by the exact same asset mass that we have. And the asset mass that we have is now around 130, I believe, million in real estate value, or basically investments backed by 130 million real estate value, out of which we expect to collect around 90 million euros. And as mentioned, that is backed by around 30 million of outstanding debt. So we are at an LTV of like 33%, more or less. So LynxCap IO is another funding instrument which will be complementary to the bonds. The bonds are targeting professional investors. There's a minimum ticket of 100,000. The usual buyer of this is kind of institutional. It's pension funds, kind of mutual funds, high net worth individuals. So this is one thing, right? And the LynxCap.io is basically offering the same economics, because we offer the same economics as the classic bond offers. It's like a 10% return, but there is no minimum ticket. It's all on chain, so fees and transaction costs, everything is cheaper, and we can address another type of audience. So this is a bit the idea. So anyone who invests into LynxCap IO is equivalent to a pension fund that holds, our classic bonds. Everybody's backed by the same asset mass, which, as mentioned, is 3 times the outstanding debt. So that's a bit the logic.
Great, great. Thanks for walking us through that and explaining what you guys are trying to build. So now, I also saw, still talking about transparency, I saw that LynxCap specifically mentions visible capital allocation. So will users be able to see portfolio level exposure, jurisdiction, exposure, recovery performance, and other default metrics? Will this be open for users and the community too?
I mean, let's say the LynxCap IO is not to be seen in isolation. There are no specific assets that back only investors in LynxCap IO, but it's the whole, right? So if anyone, or actually I advise anyone or invite anyone who is listening to go to lynxcapinvestments.com, and you'll find all our financial reports there. And there you can see the main metrics. It's quite extensive, but we don't share, I mean, we can't share like proprietary data or confidential data, like, specific returns on specific positions. We have high level information on all investments, but for confidentiality reasons, we cannot really go into a lot of detail. This is I said, it's a bit a niche market. There are certain competitors there, but there are also strong barriers to entry in terms of the know-how mainly and the connections, which we have been building for many, many years. And this is why we also need to be a bit cautious when it comes to sharing information on performance of specific investments or things like this. But overall numbers, of course, this is all available.
Great, great. So before I go ahead with this question, just for a confirmation, the average IRR is above 15%, correct?
Yes.
So now I saw that the white paper repeatedly highlights real yields generated from distressed debt portfolios, with the average IRR being above 15%. So could you kindly walk us through the exact value flow from the debt acquisition to investor payouts, and probably just walk us through if investors or users can expect yield, if there are points where there might be yield leakage or performance drag occurring?
Yeah. So let's think of a portfolio, right? A portfolio is a bunch of mortgages, for example, say 500 mortgages to 500 different people, right? So each of those has an outstanding debt and has a real estate asset that is securing the debt. Usually, the value of the real estate asset is higher than the outstanding debt. Our portfolios have an LTV of around 60-70%, which means if the debt is 60,000, the asset is worth 100,000. Now, we acquire packages of such mortgages, 500 of them, or 200 or 1,000. And they are bought at a significant discount. So usually we pay around, say, 35 to 45 cents to the dollar. Because banks have these very highly provisions, so they can afford selling at a discount. And second, because obviously there is uncertainty around it. I have no guarantee that I will collect the total outstanding debt of every case. But you can model it. And of course, we have the expertise to do so. We do spend a lot of money in doing due diligences, where we go and check every asset that is back in the portfolio. We go and check the legal documentation. We check land registries. We check everything you can check in order to make a model. And this is what builds our pricing expectation and our cash flow expectation on each single case. This gives us the cushion so that if we buy for let's say roughly, if we buy something for 1, we know we will get 1.5 or to 1.7 back, right? This is the expectation. So when you have low LTV portfolios, then you are relatively safe against some kind of real estate specific market crash, for example, because if I have with the example before, if I have a debt of 60 and I will pay, let's say 40 cents to the dollar, I'll pay 24. The asset behind it is worth 100, but I can at most collect 60 from that, right? Because that's the debt that is outstanding by the borrower. So even if the value of the property goes down to 80, I'm still in the exact same position. So this is an investment. You could see it as an indirect way of investing in real estate. We get real estate exposure, but at the same time, we get higher returns than with direct exposure or direct investing in real estate. And second, we have, let's say, a beta lower to 1 versus the real estate market. So a real estate market correction of 10% affects us barely nothing, just on some edge cases maybe, but the vast majority will not even suffer. So this is a bit how we get this protection. The biggest risks in these types of investments are not so much on the value that you can extract, but rather on the time. So the biggest risk really is that, legal processes take longer than expected, or the resolutions are actually more cases go into legal procedure, which takes longer versus some amicable solutions or refinancing or, consensual agreements with the borrowers. So this is a bit, but in terms of value, it's fairly deterministic, I would say, because we check everything. And when you check everything, there's not so much variability or volatility in the value.
Really appreciate the realistic breakdown of what users have to expect while using the platform, the values, the example being used gives a clearer picture of how the investment would happen and how the average IRR is actually being paid out. So really appreciate your answer. So I think we've been discussing back and forth on what you guys are actually trying to build. So I'd like us to move to the token, the LynxCap token, and what use cases are available for the token.
Yeah, so, what we have now is LynxCap.io, which the basic or core functionality of it is users can log in, they can connect their Web3 wallet, and they can stake or deposit USDC. The USDC is locked up for 2 years and generates a 10% return, which, as I mentioned, is fixed, so it will never change for the whole lockup period. And the yield is, as it accrues, it can be claimed. It can be claimed any day or any minute. This runs on the base layer 2, so transaction fees are fairly cheap. So users can claim their interest every week or every day as they wish. Me personally, because at LynxCap level, we are all employees also invested on personal level into this platform. I tend to claim it every week, and then I go spend it with a MetaMask debit card or something. So I just buy myself lunch every now and then or things like this. But this is what we have now. On top of this, we have an airdrop that is gonna come in the next months. Users who are already invested now, they collect points towards this airdrop, which basically the points define the allocation of the airdrop. So there is no LynxCap token yet. What we have is the staking platform. Then on top of this, we have a referral system whereby users can share their referral code with other friends and family and community. And those investors who come in using this referral code, they benefit themselves by getting more airdrop allocation. And the person who gave the referral code gets a 3% reward paid by LynxCap, 3% of the amount that the other person deposited. So this is a way how we try to also incentivize people to go and talk about this, talk to their friends, and try to get the TVL up. This is what we have now. Now, next phase, and we are already working on and developing this, has, I think, several good things to come, but I think the most powerful, I guess, is the LLT, which is the Lynx liquidity token. This is the token that we will airdrop, and this token will allow people who have some funds locked up for the lockup period to exit early, to exit anytime. How this will work is they will exit, their position, the whole principal, will be converted into LLT token at a 1-to-1 ratio. And then on our platform, there will be the possibility to redeem LLT against USDC, again, at the 1-to-1 ratio, but with a certain cooldown period. Then, of course, there will be the possibility to trade this token on the secondary market as well, where it probably will trade at a certain discount. We plan to really bring this as close to par as possible, offering several interesting use cases for the LLT token. One of them will be that the LLT token can be used directly to create a new deposit at a 1-to-1 ratio to USD. This is a USDC. So this is immediate. So anyone who wants to make a new deposit would actually go and buy it on the market, the LLT, if he can. And any discount of even 1% would be a net gain to that person. So this is how we think this incentive system will make this really trade at close to par. There is also staking for this token on our platform with no lockup, but at a lower return than the main deposits, of course, maybe some 5-6% we are thinking now, and so on, and a few more other things. There is another, but this is probably a bit later in time, idea of launching another Lynx token, which would be more equity-like. So basically, users invested into that token would have a certain upside. So, linked to probably specific investments or to the whole pool of investments. We are still trying to define this, but this is something that will come as well. So for people to have the choice to either go into something which is more like a fixed income-like product versus the more equity-like. So yeah, a bunch of things. I guess maybe I forgot something, but these are the main, I believe. The roadmap is on our website, LynxCap.io. So again, invite everybody to go and have a look themselves.
Great. The 3% affiliate system is actually a very great strategy to, even bring more users into the platform. And the kind of structure, the way you guys have built the LLT token is actually a very smart way to as well. And this leads to my next question, which is, how does the protocol prevent a situation where large-scale LLT conversions create redemption pressure that exceeds available liquidity?
Well, there is no such thing that can happen here because basically, so let's try to think of the flow of funds, right? So investors put money in USDC. This gets locked up for 2 years. Then these funds get off-ramped into euros, off-ramped and converted into euros, and invested in distressed asset portfolios. Then as the returns come in and we price these portfolios at, as mentioned, at high teens or low 20s of return, the returns that these investments generate, they allow to support all of these basically commitments we have with our investors. If the portfolio doesn't perform well enough, let's say, and then we don't get a 20 return, but we get a 15, it's still enough. If we get a 12, it's still enough. If we get a 10, then we are on edge, right? But the thing is, we never put everything into one portfolio. We do several acquisitions every year, and we participate in dozens of projects. We actually succeed in around 1 out of 20 portfolios that we analyze. So we are really selective. We are, let's say, we price cheap, which is why we win only 1 out of 20-ish, but because we are conservative. We are conservative and we price in high returns. And of course, I would be lying if I would say that we never made a bad investment. We did make a bad investment or multiple bad investments, but in aggregate terms, we tend to overperform because it's just only natural when you price slightly conservatively. On a group level, you will tend to be slightly better than how you price. And so this is the reality of our investments. So I don't foresee anything that hasn't happened in 15 years to us that it will happen now. I mean, we are safe against major market corrections. We are completely uncorrelated to crypto. So Bitcoin can keep on a free fall for another whatever time and go to whatever number. Doesn't affect us. Real estates can crash, doesn't affect us or very little. And even if that would start affecting our recoveries, as mentioned before, we have around 90 million of expected recoveries to service around 30 million of debt, right? So it is very solid. I really encourage anyone who's kind of interested in the product to go check our website. I mean, both LynxCap.io or LynxCapInvestments.com, which is the more our basically core website of the company, where you can find all materials kind of supporting these statements.
I really appreciate the transparent breakdown. You being very transparent about, some challenges that have been met in the past and how you guys were able to deal with it and overcome it is something I really appreciate, right? So, basically, we being on the use cases of the token, how you guys intend to make the liquidity, the LLT liquidity, very strong and stable. So now, could you walk us through like the tokenomics of the token? How many percent is being allocated to marketing, to the yield, to partnership, to the team? And if there is a percent allocated to the team, is it vested? How is it going to be like?
Yeah, I mean, the tokenomics are simple. Maybe first to get to that, there's basically an infinite infinite supply, in the sense that the token gets only minted when somebody who has a deposit and wants to exit it, he early exits the deposit, right? So if I have $1,000 locked up for 2 years and I want to exit, I'll be minting with that exercise 1,000 LLT tokens. And once I then go to the platform to redeem it against USDC again, and once this happens, those will get burned and then out of circulation again, those 1,000. So this is how it works. It's a dynamic supply of LLT tokens based on everything which will be in circulation is basically is a former deposit, kind of anything which is firstly put in USDC as a deposit, then can be redeemed early and converted into LLT. So this is how the supply dynamics work. Because those deposits never really, or that, let's say, committed USDC is still where it should be, which is invested in a distressed asset portfolio. So this is how it will work. Any user can mint tokens by exiting his deposit. Any user can burn tokens by taking LLT and redeeming it back into USDC on our platform. In terms of airdrop allocation, this is yet to be decided because it basically will be a function of the TVL on which we are at that time. I mean, obviously, the more TVL, the more users we have, the more generous we will be able to be, versus the opposite. If we have low TVL, low number of users at the time, then the allocation will be smaller.
Great. So
I can't give you a number at this point.
No, it's okay. Definitely, I understand from your explanation. So it's very fine. I was just asking in case there were some numbers or some percent, and so I already understand how you guys are trying to build it. So are you going to have like a token bond mechanism? Is that going to be like a bond? Did you get my question?
No, I didn't catch that. Sorry.
Okay, I was thinking, will you guys have like a token burn mechanism? Like, will some of the token be burnt after maybe some cycle or some months have passed, like to increase the demand and burn some of the token?
No, I mean the token is only burned when people redeem it into USDC. It's similar to. It's not exactly a stable coin, but it has certain features that make it similar to a stable coin to some extent. I mean, we expect it to be always trading at close to 1. And it can always be redeemed at a 1-to-1 ratio on our platform with a certain cooldown period, which will be a function of just supply demand. So there is no burning mechanism as such needed because so this is not a token that is expected to appreciate in value. It will never go because it makes no economic sense for the token to trade at more than 1. So it will always be close to 1, hopefully very close. That's why we create use cases for it that will make it be really close to par. But it's not a token that will appreciate in value. That's not how it's designed. That could be the other token that will come later on, the one that's more equity-like. There we have such an idea, but not for the LLT token.
Great. So I think these are basically all the questions I have from my end right now. So at this point, I think taking some community questions would be great. But before we head to community questions right now, I don't know, Felipe, is there anything else you'd like to add that you feel we have not covered so far?
No, I think mainly I think I explained how the platform works. I said if this makes sense to any of the listeners, I really invite you to go and check out the website, read the white paper, check out also our financial reports, and if everything looks right, I think this is a good. I think it's a good diversification for a crypto portfolio, mainly because you have a yield that is known beforehand and defined. It will not move, and you're invested into something that is absolutely uncorrelated to crypto. So, if your rest of the portfolio on days like last few days would be suffering, this part of the portfolio would just be completely not affected by any of these things, right? So that's a bit the idea. I mean, even all of those lending protocols that also pay you some yield on your USDC, you don't know exactly what they are doing behind the scenes, and some of them we've seen crashing and going down when the whole crypto market goes down, because they take your money to invest into crypto strategies, ultimately to generate a higher yield that supports paying your yield. Ours is, as said, uncorrelated to crypto. The money gets off-ramped and invested into real assets. And then once the money and the returns on the investment are made, it goes back on chain to be paid back to the investors. So it's we really believe it's a good diversification instrument on any crypto portfolio.
Okay, so let's head to some questions from the community right now. So I can see a lot of questions in the chat, but let's have a live question first. So Hot, you have been unmuted. Hot, you can go ahead with your question now.
Thank you very much for the opportunity, Moonshine. Can you hear me?
Yeah, I can hear you.
Yes.
Yeah, okay, thank you, Philip. I've been listening for quite some time now. You've given us a wonderful presentation here. I wanted to ask, do you have any means of governance, like for people who will hold your token? Do you have a governance mechanism for the holders of your token?
Well, as mentioned, there is no token as such yet. So what we have now is the platform where people can deposit USDC. So it all works with USDC. There is a certain terms and conditions that people agree to. So the whole legalities of it, I mean, this has been drafted by our lawyers. So I'm not going to lie to you. I don't know exactly what are those provisions, but it's basically anyone should read them. But as I understand from our lawyers, this is just a similar protection package than, let's say, the classic bond investor would be entitled to. Ultimately, it's the same, as I mentioned before, it's the same asset mass is backing everything. So this is the protection here that the users get.
Okay. Thank you very much for the
Thank you for the
answers.
question.
Yeah, thank you very much, Hot, for your question. Thank you so much. So before we get another live question, let me see if I can get one question in the chat in here. So Mike is actually asking, what is one piece of feedback from the community so far that has actually changed how the team is building the platform?
Well, to be fair, we just launched this I believe, around 2 weeks ago. We didn't have a lot of interaction yet with the wider community. We focused in these first weeks to do internal allocations, which we've been doing. So as I mentioned, all employees either are invested or are in the process of being invested on personal level. So we focused a bit on this part first. And to be honest, we didn't really get much feedback from outside yet. I mean, we are at a very, very early stage in that sense.
Okay, I hope that answered your question, Mike. If you have any further question, you can head to the Telegram channel and drop in your question. So let's have Elson ask a question. Elson, you can go ahead with your question, mate.
Thank you, Moonshine. I was going through your website and I was looking at Q1 of 2027, and I see there that you plan to deploy predictive yield modeling. So my question is, will this model be accessible to users to help them understand the specific risk-adjusted performance of their chosen stake, or is this just primarily an internal tool for treasury management?
Sorry, Elton, I'm not sure I understood the question. So what information are you referring to?
Okay. The link says here on the website that they plan to introduce predictive yield modeling by Q1 of 2027. So my question essentially is, will users get access to the data and predictions so they can, make better investment decisions, or will only LynxCap team use it internally?
No, yeah. Now I see what you mean. This is one of the things that we have in the pipeline as well for development. So now we have only one product, let's say, which is you can go and lock up your USDC and it gets a yield of 10%. In the future, we plan to have several combinations of yield, lockup, and perhaps each of these backed by specific things. Just to give the user more, a choice, really. If somebody wants to be exposed to only residential assets in Spain, or somebody else wants a global portfolio, or somebody else wants to be exposed to unsecured debt, which probably would give a higher return, and things like this. This is something that we plan to incorporate also in the future. And then we would offer certain metrics on these, let's say, subsets or specific sub-investments. But as I mentioned, now it's really just the global exposure to all of the LynxCap investments. I mean, it's the safest thing you can get because it's very diversified, and it's very well secured in terms of debt to assets. But yeah, those metrics refer more to specific subsets that we may create that will then go with a different yield and a different lockup period, perhaps. So, but this is yet to come. And actually, this is one of the later developments. First, I mean, our core focus now as the next big milestone is the liquidity token.
Oh yeah, understood. Yeah, it was interesting to actually see how that evolves as you guys scale. Thank you very much.
Thank you.
Thank you so much, Alsane, for bringing out a question from the roadmap. It shows you did your detailed research. Thank you for jumping in to ask a question. So to go ahead, I have Ken. Ken, you can go ahead with your question. Ken, you have it unmuted. You can go ahead with your question. Okay, while we wait for Ken, let's have Favy. Let me see. I'm trying to unmute. So I'm trying to look through the chat to see if we have another question. So a question came in here from Big Berry. Big Berry is asking, what jurisdictions are currently blocked from using the platform?
Yeah, that's a good one. So we are open everywhere globally, except for United States, Russia, China, North Korea, Iran, and I believe that's it.
Okay. So another question here is asking about, let me see. It says, what is the first come, first serve redemption queue, and how long could someone wait?
Yeah, this is very hard for me to answer. I mean, I would recommend that people who lock up their funds for 2 years, that's their base case, really, that this is money that they will not need in the next 2 years. So that would be my base case and the way I would approach it. It's like, I'm not going to put my full portfolio there. I'm going to put a part of the portfolio, whatever that part is, that I don't need in the next 2 years. And I feel comfortable with it sitting there and earning 10%. So if that is so, and the majority of people take the same approach, then there would be very low demand for early exit and redemption of the LLT token, in which case the queue would be very short. It would probably fill the same month, because we will make an allocation, a fixed allocation every month of funds and liquidity that we put aside that is to be used for those redemption. But if demand on a certain month exceeds what we make available, then it will roll over to the next month and so on. It's really, I mean, it's a bit a game theory thing. We've been modeling this, but ultimately it's very hard to predict the human behavior on the entire group of investors. We hope it is not a long queue. We hope it's not longer than 1-2 months. Because also we are trying to create incentives for it to trade at close to par on the secondary market, which would then divert many people who early exit. They would directly go into the secondary market if they can sell immediately for like 1 or 2 percentage points cut. So it's hard to say. We hope and we foresee it to be a short queue. It will self-regulate, because in the end, if you had a queue of 1 year, then it wouldn't make sense for anyone to exit and then wait a year. Then the people wouldn't even do it. Or then they would go to sell on the secondary market, and then my best guess is what we make available every month for liquidity to serve these early redemptions. My best guess is that this will be sufficient, because it's kind of defined in such a way that it's enough. But we can't control. If there is a wave of 10% of the TVL going out the same day and they want redemption, then there will not be enough funds that month, right? So this is how we can't. I mean, to be super clear, this is something that we can't fully control, but we can't allow all of or a large part of the TVL to go out and get redeemed in one specific point in time, right? Because it's against the whole logic, because we take the money and we invest it into non-liquid assets, non-liquid investments. So we can't then offer 100% liquidity if we take the money and put it into high yield but not so liquid investments. So that's the whole logic. But my guess, and after having run some models on this, we think it should be enough what we make available every month.
So Drew, thank you so much for throwing in that question. Really, really appreciate it. So let's have the last question of today's AMA from Anderson. So Anderson, you can go ahead with your question, please.
Yeah, thank you, Moonshine. Hi, Felipe. Yeah, hope you're good. So my question is, over time we've seen many, RWA projects struggle to balance attractive yields with, long-term sustainability. Hopefully this is not a struggle with this particular project, but then in case, what specific risk management frameworks does LynxCap use to ensure that yield generated from reward assets, remain stable during periods of, market stress or economic downturns?
I'm not sure I fully understood. Is the question like how we can keep the yield on the same level and being secure against market movements and so on?
Yes, that's it exactly.
Yeah.
How you able,
Yeah. Yeah. So it's a combination of things. I mean, I think some of them I mentioned before. So on one hand, we have a very conservative way of pricing portfolios. Out of 20 that we analyze, we acquire one. So you always have, in some you have more competition, in some you have more people who are really playing strong and really want to buy it, and which drives the price up. Those we don't win, but we will win one out of 20, and that will be one that has enough cushion for us and enough return. We target a return that is around double what we offer on LynxCap.io. Even if the portfolio performs not according to the schedule, but slightly worse or worse, the return will still be above the funding rate. On top of that, these investments are into, let's say, indirect investments into real estate. We have real estate exposure and security, but if real estate market goes down 10%, our investments don't go down 10%. They go down maybe a couple of points, just because of the low LTVs and on how this is, on how the recovery workout processes work. So basically, we are safe against the macro. We are not related to any crypto-specific factors. Macro collapse affecting real estate prices does not affect us very much. And then, portfolio specifics, if the portfolio doesn't perform, we still have enough cushion. So, I mean, combination of multiple things, but in the end, we have 15 years of track record, and we see that if you take all of our investments together, there's always a small overperformance even versus our business plans, and not the opposite. And this has gone through many economic cycles and through crashes here and there and on different markets. So, I mean, many things, but overall, it's a stable and solid approach on which we don't foresee any any losses occurring, because they haven't in 15 years. So we feel quite comfortable in the space.
Okay. Great answers, and it's good to see you have all this sorted and out in such a way. So we're hoping a very good one for the project, and cheers.
Thank you.
Thank you very much, Anderson, for the questions. So these are all the questions we'll be taking for today's AMA. Thank you all for the questions in the chat. I know I wasn't able to get to all the questions, so if you have more questions, kindly head to LynxCap X, or you can follow them on LinkedIn and ask whatever questions you have. I'm sure the team would be willing to answer your questions. So before I close down the VC, Felipe, do you have any final statements to make?
No, I mean, thank you so much for inviting me. Thanks everyone for joining. As I mentioned before, I would just recommend you to, I mean, if there are outstanding questions, for sure, reach out. I think you have all of the channels where you can find us. And I encourage everyone to just check our platform, read through it, and see if it makes sense to anyone. For us, we developed this with a crypto user mindset, basically, because me personally and other members of the team, we are. So we really tried to let's say to overcome all the flaws that we have seen in different DeFi projects. So this is the answer to all of these well, sad stories that we had over the years in the DeFi space.
Okay, thank you so much, Felipe. It was really an amazing section with you, how you're able to give explanatory answers to every question that was asked. Shows how knowledgeable you are about what you guys are building, and that is something I always appreciate from everything that comes here to present in such a manner. We hope that in the future, when you guys have more updates, you've crossed certain milestones in your roadmap, we have you back at GoldDiggers to present and let us know how far you guys have gone. And I just want to encourage every listener right now to engage, follow them on X, follow them on LinkedIn. That is where you get updates about what LynxCap is building. And don't forget, there is a 3% affiliate program currently going on. And the yield rate is also very sustainable and very stable. So it shows that the project is trying to build something very solid in DeFi. So I wish you guys have a great day. And don't forget, we have another AMA coming up today. So see you guys in the next AMA. Thank you all for joining and have a great day.
Thank you. Bye.